I don't know when my body's actually going to break down and never recover, but it is a weird zone moment in my life where I still think I'm 30 years younger than I actually am.
How do you run a business based on like this ridiculous environment?
Nobody wants to buy. I mean, it's a whole greed and fear. Buy while others are fearful.
Like, this is chaos. No one can predict the short term. Really, as an investor, the best use of your time is to try and manage your own emotions and not panic.
I think better values are had when people are terrified than when they're confident.
It's the pessimists and the bears. Those guys sound smart, but it's the optimists that win in the end.
I guess the lesson being there's always opportunities in the market, regardless of what the fear is and what the expense ratio is or whatever's happening. There's always a way to do well.
For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Hello and welcome to the latest Wall Street Wildlife with Christoph and Luke. If you caught our last two episodes, we were in a panic about market chaos. As of today, the 14th of April, the S&P is in a 13% drawdown. Is this just volatility, or could this be catastrophe? Are we stumbling into a changing world order? That and more in this week's hot episode.
Speaking of catastrophe, Badger, this old dinosaur here still thinks he's like 17.
You look 17.
And so
with that beard off, you now look 17 as opposed to 17.
Right. Well, I made improvements, but my body is a complete catastrophe because I still thought it's wise to do a lot of running and then jiu-jitsu and then go into the weight room. So I have my hamstrings all messed up and my elbows all messed up and I could barely roll out of bed. So, I am like cobbled together with duct tape and crazy glue. And I'm proud of myself because, with my body so broken, I'd put on a heavy rucksack, go down to try to get some blood flowing to my extremities. And then what do I come back to? But your encouragement, like you see my Apple Watch captured like a 0.35 mile segment, somehow failed to upload the 5 miles beforehand. But you were like, way to go, buddy.
Don't overdo it, monkey. I believe it was my Strava comment.
That's right. That's right. Don't.
Right. Okay. I thought you literally did a 0.35 mile hike. And so, yes, I took the piss. And I responded by doing a half marathon yesterday and thinking exclusively about the Patreon.
Right. You had to.
But if you did 5 miles with a pack of beans, then fair play. No complaints.
Yeah. No, but I don't know if you have, you're my senior by only a couple of years, not too many years, but
half decade or so. Yeah.
Is it half decade?
I think so.
Okay.
Yeah.
Well, my God, I don't know when my body's actually going to break down and never recover, but it is a weird zone moment in my life where I still think I'm 30 years younger than I actually am, and my body just refuses to cooperate.
Actually, maybe I was unfair to you there. It might be more than a half decade, but somewhere between half and a whole decade. Like, yeah, as you get older, you just get used to the fact that stuff doesn't work as well as it used to. Like, I have to wear, like I did my half marathon yesterday. I actually went out with the intention of doing like 5K, and I did like 5K. I'm like, actually, I'm enjoying this. And it became 10. Then had some ideas for the Patreon because inspired by the fact that, hey, here we are. We now have some fancy Wall Street Wildlife mugs. Patreon sent me some samples.
Oh, look at that.
Team Badger, Team Monkey. Yeah, nice. Exclusive Patreon merch. So I was thinking about that while I was running, and then like my 10K turned into 20K. But I have to wear like an ankle strap because I've got like this just chronic, like I rolled my ankle over 6 months ago and I just keep twisting it. And I can currently no longer lift like this arm higher than this point because I've given myself some kind of tennis injury because I've been playing tennis too much. So yeah, you just get used to the fact that like stuff doesn't work.
I heard that the most immediate fix to all this is to get a lot of sexy nurses to tend to the wounds.
That sounds fantastic. Yeah.
Yeah. Okay.
Let me check in with Katrina, see how she feels about that.
All right. So that's one kind of catastrophe. You want to talk about market catastrophes and where we are after a week later after our 2 episodes when things felt like absolutely devastatingly brutal and crazy.
Yeah, I mean, and yeah, so things still feel crazy. Like, this is what, Monday the 14th, and the latest like nonsense is, well, I saw a good summary tweet of it. It was like, tariffs announced on Thursday. On Friday, semiconductors get a dispensation. By Saturday, the dispensation is rolled back, and like it's going to be reframed as a specialist semiconductor tariff. One small example, but if you were like importing a ton of like technology, you'd be like, your emotions would be flipping like left and right, because this administration can't give a coherent story about what the damn tariffs are, what they apply to, how big they are. Like, how do you run a business based on like this ridiculous environment?
I have a great personal anecdote on this. And by great, I mean queasy. One of my good buddies here in Austin, fantastic guy, just sweet as can be, just a mensch all the way through. Studied winemaking down in New Zealand and took his arts and skills into making cider. So now, if you're in Austin and you go to any supermarket, really, and you're in the wine section, you're going to see the Texas Keeper uh, cider brand. It's absolutely delicious. For any of you Austinites, listen to this. He, over the past week, did not know where his glass bottles would come from because he was using a company over in Europe. And so when, the tariff stuff went into place, he needed to get on the phone. He's negotiating contracts and so forth. And the takeaway, last I heard him tell me about this, was they said, we cannot send you bottles or glass because we do not know what the price is. I mean, that's as a real example, I think, like on the ground example, like how do you know, how do you proceed when you can't get the bottles into which to put the cider because the company can't economically tell you what's up and what's down? That's very scary, I think.
Yeah.
It's one thing, like maybe if you zoom out and think of like semiconductors and Nvidia, like these massive macro companies, like some way I'm like, things will sort themselves out, but the everybody else that can't buy glass, that's nuts.
Yeah. And well, like, if you're importing stuff, let's say from China into the US, like that is a major trade corridor. Like when you bought those goods and maybe, you paid up front for them and they were on a ship, like you had no idea about the tariffs, and now they've landed a few weeks later, and they're like, potentially you've got hundreds of thousands maybe of containers now, like en route or building up in ports full of stuff that the importer can no longer afford economically to like pay the tariffs and actually like land the goods and use them. So like, what are these container ships going to have to like turn around and try and sell at a discount somewhere else? Are the American ports just going to get clogged up with like containers that no one can afford to open? Like, there's a whole bunch of really complex questions that I've got to wash through here.
It's utterly bizarro. The last thing I heard over the weekend was that Trump backed down from tariffs on things like iPhones.
Mm-hmm.
Did you hear about this stuff?
Yeah, but then again, that's part of this like they're going to, now we heard on Saturday there's going to be like a semiconductor tariff which is going to get announced in the next couple of weeks. So you were feeling good if you were Tim Apple for like 24 hours, and then you're like, oh, we're in trouble again.
Right. I actually went to a store looking for a new iPhone because my battery's getting all wonky and it's, pain in the ass. Even though I still like the phone, it's totally fine, but right, traveling battery, yeah, whatever. And then it was the tariff stuff that I read, some places saying get your new phones now because they might be $2,000, $3,000, whatever, a couple months from now. And then 2 days later, right,
Yeah.
there's this news, phones are going to be spared. But I'm thinking about all this, like how weirdly it's all interconnected, like Tim Cook, as I don't know if you came across this, right? He's definitely a lefty, right? He's always on the side of leftist progressive politics, but there he is on stage donating to Trump. I don't know what the amount was, right? I mean, it was massive because obviously he's trying to, save his company
Got to
from
play the game
from
like with everybody else, right? Yeah.
yeah. And it's just like, I don't know. It seems at this moment to me, I know I'm rambling a bit. Feels like I'm rambling, like like a showmanship game. That is Trump style, right? Just like hardcore negotiation in this like Wild West style, like who's gonna blink first kind of stuff. And I just don't. I don't know if that's even reasonable, or maybe it's so uh unreasonable that it somehow becomes reasonable in a very weird like you come back to the same place but see it from a different way. I wish I had something more intelligent to say, but I think everyone's scratching their heads, and I still don't know what to make of it, to be honest.
And if we think back to our conversation of the last 2 weeks, I think our biggest conclusion really was like, this is chaos. No one can predict the short term. Really, as an investor, the best use of your time is to try and manage your own emotions and not panic, but just focus on like the quality and the results of the companies you own or that are on your watch list, and then try own the right stuff for this market. I do have limit orders on a bunch of stocks, and at the back of the episode, I'm going to share my limit prices on a couple of stocks that I'm looking at. But yeah, I've got no idea about what the next couple of weeks, next couple of months are going to hold.
Right, no one does. And although major, I think, alarm bells, there are some people, if you follow them online, that claim they do know. Stay away from those. They don't. I want to start, Badger, if you don't mind, with two charts that caught my attention. So what you can see on the VIX chart, let me get into the weeds just a little bit by saying this is based on options. Options, if you remember, have a mathematical formula that determines how much somebody is willing to pay for a contract, and one of the fundamental variables is called IV, or volatility. So the higher the volatility, that means the more likely the contract will go either up or down in value, making it either more or less expensive. Because if you're right, you can make a lot more money, right? If there's not much volatility, it's kind of assumed the contract will stay probably within a reasonable band.
And in like, explain it like I'm five language, that essentially means that options traders think we're going to see like a significant movement either up or down from the current price, as opposed to like low volatility, we'll probably see a smaller movement.
Right. And translated into normal speak, I suppose, non-tech speak, it's basically gauging fear. Fear is a dance partner with volatility. Why are things more volatile? Because there's greater fear or uncertainty. Fear and uncertainty, maybe both, right?
Yep.
So what I like about this chart is there are, if you look at it, Badger, there's one candlestick that is the highest. Take a guess. Take a guess what that one, when that one was, without looking at anything else.
One candle. You have to explain what is a candlestick? What am I looking at? I don't use these diagrams.
So the candlestick. So here on this particular chart, I set it to the monthly time frame.
Okay.
That means each of the bars that you see represents the price of, in particular, this index. It's low and it's high. So that's what one candle shows you in that month.
Okay.
This is the lowest price and this is the highest price.
Got it. Okay. So that thing in the middle, which is like COVID, I guess.
Exactly.
Right.
And you don't need to know anything else, but that was the scariest things have been over the last 5 years. And technically it reached an index price of 80, something like 82. And if we went back to that moment, right, it felt utterly terrifying because the entire global economy was shutting down and we didn't know what was going to happen. So it makes sense to me that that was this kind of major peak. And then we see it dropping over the next 2 years, right? And then kind of staying relatively, I mean, everything was then under 30. And then over the last, from 23 to like 25, we were kind of hovering around numbers like 15, 16, 17, this downwave. So that meant things felt pretty stable, right? Inflation battles, trying to contain all that. And then there's another big peak, another major uh, giant candlestick that got up to 60, something like 62, 63. Do you remember what that was?
No.
That was the whole Japan carry trade stuff.
Oh, okay.
Remember, everyone was panicking, like the markets start crashing because we think Japan's going to raise rates, and then that's messing all this leverage up and so forth. That didn't last very long, but notice, like, look how high that spiked and then went down pretty quickly. For our purposes, we are right now, because of the, I guess, tariff stuff, the VIX index spiked up to 60, which is the third highest spike on this charts in the last 10 years. And now it's retreated back down to, at this moment, 31. So basically retreated 50% already in this moment, suggesting that the markets, got terrified, but now we're 50% less terrified than we were just a week ago. Why does all this matter? Well, in some sense, I'm telling you, this is kind of more like a compass I use for myself, because all other things being equal, I think better values are had when people are terrified than when they're confident. So that's just one thing, right? But the other thing is that I found a chart that I thought was really encouraging. And what we see on this chart is it ranks the highest closes since January 1990 to April 2025. The highest close ever was, no surprise actually, October 24th, 2008, where it closed at 79.1 due to the great financial crisis. And all of the top ones are around 2008. The next one is the COVID stuff, closed around 66. And then on April 4th, so 2 weeks ago, we got a close of 45.3. So that is basically, it's a historical kind of close, right? It makes the,
And I guess if we, again, let's just like reground ourselves in what we're actually talking about here. So you're drawing a line at the volatility, like the uncertainty, perhaps in the market, maybe a simpler word, like the most uncertain times of the last 2 decades or so have been the great financial crisis, 2008, COVID, and then now. And I guess if we, rather than 45 on this picture we're looking at right now, if we plug in the 65 or whichever number you just gave us, like that puts us near the top of this chart as being one of the most uncertain periods of the last 2 decades.
right, 20 over the last, well, according to this chart from 1990 to, so over 3.5 decades. So this is, we're looking at 35 years.
Right.
So this is certainly, without question, a moment, if you will. We're having a moment. But this is the encouraging bit. If you look at the forward S&P returns from all of these peaks in volatility, what we see is that basically the numbers are staggeringly green. From the peakiest of the volatility indexes, 79.1, the 5-year return from there was 122%. Beneath that, it was 151%. From COVID levels of March, the returns 5 years afterwards were 164%. And so basically there's none of these peaks where 5 years later the return was not more than 100%. So if you analyze that, that's over 20% per year. And that's, I think, the main takeaway that you and I'm guessing, fundamentally agree on, is that while in the moment it's absolutely terrifying, statistically, it's 100%, like based on this chart, statistically, the odds are 100% in your favor that the returns from this particular spike are going to be fairly massive. Now, that we're not financial advisors, this is in no sense a guarantee. Nobody really knows anything for sure, but I like these odds for sure.
I'm with you, and I think I agree, but let me set out some counter arguments. Things are still expensive right now. And like what this picture we're looking at right now probably doesn't show us is like the extent of the drawdown at each of those periods. So right now, the market is in a 13% drawdown, i.e., from the last like highest point, which looks like it was directionally like late February. That was the last market peak, and we're now down 13% from there. And that's not a huge amount. Like we've had much more significant drawdowns in the past. And as I mentioned last week,
technically, if I may, there is one dot on this chart that does approach 20, right? It was like 19 something.
Sure.
Percent.
Yeah, okay, that's fair. That's fair. Yep. So okay, let's say the worst we got was like a 19% drawdown. Fair enough. Good shout. Even that still isn't super material. Like stocks are still expensive. We talked about this just last week on the podcast. Like I'm trying to avoid personally looking at like big market movements and things like that. I'm trying to focus on the specific companies I'm invested in. Like in the main, they are still freaking pricey. And that'll bring us onto the limit prices I've set at the back of this episode. Like I think we've got a long way to go before at least the stuff I want to invest in is available at bargain prices. And there is, so like, complex, chaotic time, highly uncertain time, but still at like, in my view, relatively like not cheap right now. Even a few weeks ago at minus 19%, like not cheap then, especially.
Well, this is what makes us such a fantastic dynamic duo, is because I think your eyes are primarily on stocks that are, as we always talk about, excellent companies and therefore still richly valued. So for you to say stocks are mostly still expensive is, I would agree, fundamentally true. And even if you take the index average on the whole, I think it's still like a 20 forward PE ratio or something. So yes, I fully agree with you. And the stocks that I've been mucking around in, or stocks / something like Chainlink, which is just at the beginning of its journey, I've been making the argument that they're not really expensive because they're either pre-revenue or they're completely out of favor, as in biotech, and they're actually incredibly undervalued. So for us listeners, I think it's really useful to not categorize everything in just one bucket and know what frame you're using to make a statement like that. Because I guess the lesson being, there's always opportunities in the market, regardless of what the fear is and what the expense ratio is or whatever's happening. There's always a way to do well.
Yeah. What story have we told so far? You've told us really a nice, clear story about when things have been volatile and uncertain in the last 35 years, they've without fail, pretty much, not financial advice, they've without fail, like come back within a year and certainly within 5 years, still like gone on to more than double over like a significant period. And I think, if you take the 10-year to 20-year view, like it's very hard. There are very few points in history where you got wiped out. But there have been some points in history where you have been wiped out. So here is an interesting counterpoint from a website I read quite frequently now called Banker on Wheels. And they've poured in some data from Bridgewater and Credit Suisse. And this is a little bit cherry-picked perhaps, but it shows like when things go really, really bad, like generationally bad, not even generationally, like 100-year bad, they can go really bad. So, and in specific markets. So if you were invested in Russia in like the mid 1910s, you got wiped out and your market went to zero. And the same thing if you were an investor in China during 1949, your market went to zero. And if you're invested in Germany or some other parts of Europe during the Great World Wars, you suffered a 99% drawdown if you were invested in Germany during World War One, and it took you 47 years to recover. So I ain't saying Trump is like Germany in World War One, but Trump could be precipitating something like the Great Depression, where investors took an 85% drawdown and it took them 16 years to recover. Trump could be leading the US into like an example of massive inflation that the UK had in the 1970s, where UK investors got wiped out to the tune of 72%, and it took 11 years to recover. Like, we could be going into a very, very significant period where perhaps, and I think we're going to talk about Ray Dalio's A Changing World Order, like perhaps the rules of trade and the rules of how the world works are changing so fundamentally, there's kind of no coming back.
Badger, I have one question based on that little mini lecture there. What's the state of Monkey's body going to be 47 years from now?
Yeah. I mean, you might be.
How many pull-ups will I still be doing?
like if your portfolio gets wiped out to the extent that this picture's showing, right? That might be your job, literally like carrying packs of God knows what, like goods from place to place.
Also, follow-up question. I don't know if you know the answer to this, but the Korean crisis, Asia crisis, 1989, 1998, has a bicycle icon on it.
Oh, that's Banker on Wheels sticking his logo on the thing to say this is my graphic. So we'll definitely give them a credit in the show notes for today.
Yeah, right. So this is why I feel, rather than say panicked or cautious, I feel more than anything curious, because when I look at all these historical periods, contextually, I could see, right, Russia gets wiped out because their entire world order is flipped up and down between what even is labor and ownership, right? And anytime you kill something like hundreds of millions of people, not great, right? Like stuff like that. But now, under the age of AI, which I'm translating here specifically to, not that there's going to be fancy robots doing stuff, although that is coming, that the rate of innovation is faster than ever. I have almost like a built-in uncertainty variable that says, okay, even if things were to get, say, really bad this year under Trump's policies and things get really shaken up, I have more of a foundational confidence in the innovation bit that that it's as believable to me as not that we'll innovate our way out, certainly faster than what the shortest years of recovery on this chart was 7.
Mm-hmm.
I don't know. Like, I think to myself, things get really bad, right? Let's say we enter dark times for the next 1 year, 2 year, 3 years. I have a hard time like really feeling like 4 years from now, or whatever random number, with robo taxis zooming around and whatever, and robots making stuff at factories. Like, it's hard to kind of picture dark ages, harder to picture the dark ages now than ever before.
I agree. And like, I am an optimist in my core, and I'm an optimistic investor. And like, it's the pessimists and the bears. Those guys sound smart, but it's the optimists that win in the end. And I think I made this argument like a year ago when we were chatting to your buddy, Mr. Not Advice, about like doomerism. Like, if you keep an optimistic view of the future, and if you can invest with good principles following that view, like, the upside is so significant compared to the downside, you're probably going to prevail. And I still feel that's true today. But I think it's useful for us to ground ourselves in a little bit of history and how things could go badly wrong. And like, I don't know if you want to take us into, you shared some thoughts from Ray Dalio. Like, there is like the end of something quite significant. Do you want to explain what that was all about?
Yes, I will. One thing first. Do you know the joke about the glasses half full? So, to an optimist, the glass is half full. To a pessimist, the glass is,
Half empty.
yeah. And to an engineer,
No idea.
the glass is 2 times as big as it needs to be.
Okay.
Wall Street Wildlife is brought to you by the Chit Chat Stocks podcast. My name is Ryan.
And my name is Brett.
And we're the hosts of the show.
On Chit Chat Stocks, we are constantly researching new stocks from high flyers to undiscovered small caps, diving deep into business models, debating competitive advantages, dissecting valuations, and we have a fun time while doing it.
Supercharge your investing research and start listening to the podcast today. You can follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts. Follow the show so you never miss an episode. That is the Chit Chat Stocks podcast.
Because, all of those are lenses, through which we see the world. So I felt pretty good about the recent blockchain book that we did an episode on, and we got really good feedback from our Patreons over at patreon.com/Wall Street Wildlife. I thought it was a deep dive. I think, well, you're the best guinea pig, right? About, you had a view about something, and then I talked about it, we talked about it, and then you ended up, I think, reframing some fundamental understandings about a big upcoming industry, right? I have
and actually, just for podcast listeners, like, that was a Patreon exclusive episode. We do plan to release it on the podcast feed, and I think we're going to do that in May when I go on my motorcycle tour of Sardinia, because I ain't taking the laptop with me for that trip.
Right. Okay. Cool. So I have on my top of the to read stack is this book. Next to read, The Changing World Order by Ray Dalio.
Now, can I just say very quickly, like, my good friend Dunya in our investing WhatsApp group, I've been chatting about the two charts that we just showed, like the VIX and then the like, could this be the end of the world chart? She popped up with exactly the same book and a couple of extracts for me. So I love that you've picked up on this one.
Yeah, excellent. And I love that you're still not going to read it. So
books, right? Books are out of date. Like, if you're in this world, it's you get no value from reading a book. There you go. Controversial statement. All that shit behind you, the only thing that's of use behind you are the bottles of whiskey. They're the only thing that are going to get you through like this time. Because if you read a book, it's out of date before it even hit the printers.
Oh my God. Yeah. Anyhow, I came across on Ray Dalio's feed, I thought, a really nicely animated 4-minute semi-summary of all these many pages. To Badger's point, like, why spend your time really thinking and taking your time and going deep when you could have pretty cartoons telling you all you need to know in 4 minutes? But I was impressed with this little mini slideshow. So we'll link a show note to it. What I see there is, humans are pattern making machines. So we look for patterns anywhere we can. But in this overly simplified graphic, you see the Dutch Empire in the yellow line kind of going up and then peaking and then going down. And on the way down, you see a new blue line, dark blue line with a British flag, the old Union Jack, starting to go up and then peaking and going down. And then at a sort of similar interval, you then see a light blue line. While the British is on the way down, the light blue line represents, obviously, the United States of America. And on this particular graphic, you see that light blue line also descending from its peak, and the beginning of a red line with the Chinese flag on its way up without them having crossed. And of course, we don't know how that's going to play out. But mathematically, what you're seeing is a predictable pattern repeating at predictable intervals with basically the same shape. So a historian, which this is a kind of history, economic history, is saying why it's inviting to me the question, is this time different? why would it be different if it is? If it's not different, then the US, as one of our Patreons, I think wisely asked us to consider, is the US now becoming uninvestable? Because why would you invest in an empire that is collapsing? So I think historically zooming out like this is really interesting. The burden of proof, in a sense, when you're presented with this kind of data, is to say, okay, it is different because, right? And then you start naming things like AI and whatnot. But I think in the video there's I mean, that's interesting, but he got more granular, and I thought this was maybe one of the more interesting things to think about from an investing standpoint. All those lines eventually, their data, what data are they using? And he breaks it down, like, what does it mean for an empire to crumble? He came up with, I believe it was 8 categories that are measurable, and you basically measure all those categories and you get a number, and then you track that number and you see if the graph is going up or down. The categories are, and then I'll read them off: education, technology, competitiveness in global markets, economic output, world trade, military strength, power of the financial center, and strength of the currency as a reserve. As an educator, and we as technologists, I think those are the first fundamental points I think we're always talking about. It makes sense to me that if your country's education is somehow falling apart or behind, then that's a direct correlation to its capacities as a technological powerhouse. And as we now know from things like chip war and the book Chip War and how central Nvidia is to the world, well, everything depends, like the military itself, the state of America's or the world's security depends on its access to these highly technological chips. So all these pieces are connected. And I suppose one way of assessing to the best of our ability whether America's on its way out or down, or is it going to reverse the historical trend, is to ask ourselves, how's the education doing? And how's our technological center doing, right? For all the fear and running around with craziness, can we measure? Can we get an intuitive sense of technology being stagnating, declining, or actually progressing? Because if we could fundamentally sort of answer those questions, then I think the rest of it will turn out to be kind of noise, and it's easier to interpret all that other stuff as noise and say, no, okay, things are shaky, but our chip lead is still decent, and yada yada. What do you think of all that?
No, I think it's a good observation. And I don't know if the US is dropping into like a spiral of decline that it will never clamber back out of. But it makes sense to me intuitively that those are some of the things you could measure that would give you like an objective sense as to whether your society was like rich and healthy and prosperous and like culturally rich and like not going to do like I suppose in the book he probably talks about Rome as well, right? The decline of Rome, and you can probably, I'm not a historian, but you can probably point out like a whole bunch of things where like Roman society fell apart, and that precipitated like the end of them as being like the global overlords.
Yeah. Here we see the historical labels on what the rise looks like, and then what the decline looks like. And at the peak, it's basically, you see that there's the biggest gap in wealth between those who succeeded and those who didn't, which when the downturn happens leads to things like printing more money, extending credit, and eventually revolution and war, because the gap between haves and have-nots is so big. Living here in the grand old US, this is exactly what it feels like.
Right.
Obviously, inflation and printing of the money and so forth. What's curious to me, I can't help myself, forgive me, but one of these points is the power of the financial center. Badger, I think it's obvious to you why this is another reason why I'm so intrigued and bullish on blockchain technology and Chainlink, because I think this is what they're saying. Like, we need the US to remain the sort of leader in innovation around how global finance works. That's why we need to invest so heavily in the crypto industry, not the circus stuff for the thousandth time, but the builders that are actually saying we need everything to move on to this better way of doing things. And if we do, then the sort of money, the US would remain the money center. And that's another reason for me to be cautiously optimistic that even though we do have things like a bunch of money printing and inflationary effects, the technological stuff is also now being, supported and no longer obstructed via regulation. So my takeaway is I remain cautiously, I don't know if optimistic is the right word, more like I don't necessarily see an inevitable decline because there's too many other factors that make a reversal possible.
But I think you can take that same argument though, and you can apply it to any successful big tech. Like if we just take, I don't know, Apple and Alphabet and Amazon, like 3As from the Magnificent Seven. Like these are US companies, and they probably generate the majority of their revenues in the US. But they're essentially like globally regulated. They're global organizations. If the US, let's take an extreme situation where the US did like fall into Ray Dalio's like irreversible decline, and maybe he's right, and China follows that red arrow and goes into its ascendancy. Like companies like Amazon and Alphabet and Apple still have such a commanding lead with very little external challenge. Who really is challenging Amazon at a global level? Nobody, right? And probably nobody ever will. In some ways, like these corporations perhaps could outlive the regimes that they grew within.
That seems possible.
And as an investor, like maybe that's the only important thing. Like again, like paring away like 99% of the noise and all the stuff that keeps you awake if you're like watching the news and you're on Twitter or wherever. And if we take the sort of lesson from last week's podcast, which was there's all this noise, unpredictability, who knows what's going to happen? I certainly don't. Just focus on owning like the best companies in the world. Like you could take that same somewhat selfish lens and just say, okay, like even if over the next 20 years, like the US disappears up its own backside for various kind of policy reasons, as long as I own the world's best companies, like they're still going to be the world's best companies in 20 years' time.
I like that argument. Fundamentally, I'm a little bit, my contrarian view is, I just need to mention it again quickly, that at the same time, things like biotech, for example, as an industry, we know some of the world's most valuable companies are giant big pharmas, right? So there's a lot of, when you invest in the right one, these are also life-altering gains. And right now, in this moment, over the last 4 or 5 years, basically since the peaks the peaks of 2021 where valuations were really high, the whole sector has been utterly decimated. So that I think I came across a stat that right now there's over 200 biotechs are trading for less than the cash on their balance sheets. And I talked about Relay Therapeutics as my favorite of them all. It's in moments like this that there's a reason people are not interested in buying these companies. But if you could really hone in on the ones that have the best shot of winning, your returns will be absolutely superior to the rest of the market because nobody wants to buy. I mean, it's a whole greed and fear, buy while others are fearful. So I think as investors right now, we have this really wonderful moment where you could, I think as you're doing, being very vigilant and looking at the world's best companies and kind of trying to pick your spots when out of confidence, right? That it's going to be a good time to buy, maybe, sometime soon-ish, you could tell us a little bit more about that. And I'm saying there's also this whole other bucket that's worth investigating, specifically because others are not, and they're throwing out the baby with the bathwater type stuff. So do you want to take us, Badger, to your own recent limit order?
Yes, I guess. Why not? I guess last week's podcast, what did we observe? Like, things are still expensive, and I'm like bargain hunting, but not finding any. And I came up with like a really scrappy shortcut mechanism, which told me things were still expensive, i.e., at the peak of pessimism last time, which was 2022, give or take. Many of the companies I want to own more of were trading materially cheaper on a price to free cash flow basis than they are today. So the step I didn't do, because this is literally like my live thinking over the last couple of weeks, like I really want to do something just like everybody does, like, oh, shit, like my portfolio's down. I'm down a little bit more than the market since the last drawdown. I want to take action, but I listened to our own podcast and I'm reminded the best thing to do is do nothing. So I'm trying to find some proxy to do nothing where I can actually feel like I have agency. I'm doing something. So the something I've done is I took that logic from last week, just went one more step and said, okay, if we were at peak pessimism for these 4 or 5 companies, so I had a long list of companies that I think are overvalued, that I own, that I want to own more of. I pared that down to 4 or 5 companies that I really want to own more of, because I feel like the world situation right now plays into their hands. Companies like Amazon, I think if we do go into a recession, it's probably going to help them, even though the tariffs are probably going to hurt them. I feel like a company like Amazon under Andy Jassy are going to navigate that probably more adeptly than smaller competitors in the same space. And so I took those peak pessimism numbers and I just translated them to like a price target for like the current market. And so I did something. Like I felt like I'd taken control because I set some price targets and I put a couple of, actually I didn't quite, I said on the Patreon, I put like limit buy orders in on about 5 things. I didn't quite do that because for some whatever weird reason, I have to, if I want to put a buy order on something, I have to actually isolate the money and I can't use that money on anything. It's got to sit there in cash. So I have put an actual buy order in for Meta at, I'm not going to share my specific numbers, but directionally about $350, $360. I have watch listed Amazon at around $130, $140. I've watch listed ASML, the guys who make the machine that makes semiconductors. I've watch listed them at about €400, and I've watch listed L3 Harris, like one of the defense primes, at around $160. The only other one that I've watch listed that I think is going to trigger fairly soon. Now, those prices are all materially cheaper by like 30% cheaper directionally than the current price, which is like an indicator as to how bad I think things could get from here. The only other one I've got on my list is ticker NU, Nubank, the Brazilian fintech, and I've got a watch list on them to buy them at around $9.50, and that's a lot closer. They're currently trading at about $10.15. So that one I kind of expect to execute. The other ones are probably not going to execute, but at least I've satisfied my itchy fingers, my desire to do something without actually doing something.
What a magic gimmick. Badger does something without actually doing anything.
There you go.
You know what? My pushback, little pushback is this. One, there's a little bit of an anchoring fallacy when we say because it was this high at this point,
Sure.
and now it's 30% lower, that kind of assumes that 30% price was either the correct price or, what if it was wildly overvalued at the peak? And
so just to be clear, I came up the other way. So I derive these prices by looking at So what was like the free cash flow multiple at the peak of pessimism in 2022, and then if I had that same free cash flow margin today, what would the price be? So it's like the other way around.
Oh, good.
Yeah.
Okay, good.
Yeah.
But I think the more significant criticism for me, and by the way, when I say criticism, it should be obvious. It's not even something I would necessarily dissuade people from doing. It's just like a different lens to look at the issue, which is it feels a little bit like market timing. And I say that because we've known plenty of instances where somebody sets a limit order at whatever price that seems like really, really good. It never fills because it never quite drop. It stops just, let's say, $1 above what you set it to, and then goes on 20 years later to produce massive returns. And of course, because that's somebody's mindset, they say, okay, I set it at this price. That's kind of the correct price. It never filled, but now it's more expensive. So of course, I'm not going to buy it when it's now even more expensive than when I wanted to before. And then they never buy it. And then basically what it amounts to is you missed out on massive gains because you weren't willing to pay $1 more. Now, that's a problem because obviously we all recognize that limit is kind of arbitrary, and whether it hits or not, like price movements are sort of arbitrary. So you're kind of playing games with market. I think market timing is my shorthand for all of that, which is why I'll land this plane, why you saw me in the King of the Jungle. As is my way, I have the companies that I know I want to own more of, and first of the month comes, I'm basically putting in 75% of the funds without these limits because I don't want to market time.
Yeah, no, fair challenge, and you're exactly right. In the main, I already own these companies. Like 3 of those 5 I just listed, I've already got like probably between a 1 and a 3% position in. They're just companies that I want to add to. To be fair, I don't own Meta or L3 Harris today, and so I am kind of market timing by sticking like quite low price targets on them. But like I'm going to monitor this is my thinking. My sentiment is that things are going to get worse before they're going to get better, which is why I'm still 25% cash in my investment portfolio. And like I've talked about it ad nauseum in the past as to why that applies to me and maybe not to them, like the majority of our listeners, because I don't have an income. I'm not adding like a chunk of my paycheck to my investment account every month. So I'm sitting on that cash hoard because it's got to pay like my monthly bills. But also I want to, like I release that cash at objectively high valuations up between over the last 12 months, essentially. But I went quite hard in November, December, January to sell stuff. And I get my advantage by putting that money back in play at objectively reasonable valuations. And looping back to where we started this conversation today, like I don't feel like these are reasonable valuations today, which is why I'm trying to hold my nerve right now. But I'll review as we go. And like if we come out of this and maybe we get some stability and it feels like I'm more confident again about the direction of the world over the next 12 months, well, I'm just going to forget this shit. I'm just going to buy these stocks.
And maybe the takeaway, maybe this is a good place to end today's episode. What I like listening to ourselves too is it seems like you don't have to pick one or either of our strategies. You could kind of hear us talking and saying, okay, well, what's stopping me from putting in a few limit orders, Badger style, but also picking up a few shares of some of Monkey's companies that seem really promising and don't really have much to do with valuation. It's just, are they going to succeed or not? And you kind of split the difference and you stop thinking in these kind of binary all or nothing methods. And over time, you'll see, you collect the data and let's say Badger is right and Monkey was completely wrong based on this, and this criteria. So going forward, you might then weigh a little more heavily towards one strategy than another, and you keep adjusting and kind of being more and more flexible. That seems to me like what the better investors over time learn to do, like pick their spots. Poker play. I mean, this is obvious poker analogy, right? The great poker players kind of take on a persona at the table, right? But then they slyly shift it, right? Because they know somebody has pegged them as, let's say, an overly tight investor or overly loose, but then they switch it up so that it becomes harder to know. But that requires reading the room and just being more sensitive to the data. So that's what I would encourage our listeners to do, really.
Yeah, and like maybe that the poker analogy, it certainly is true at the poker table. I don't think it applies so much in the investing world, because it's not like you're trying to fool the market, because none of us have enough money in play that we actually influence the market in any way. Like maybe if you are Ray Dalio, maybe you do influence the market to some extent, you drive sentiment. But there is certainly, like, the takeaway from that, I think, is there are lots of ways to be successful as an investor, as a poker player. And it's about knowing, like, the styles that you're comfortable with, maybe learning the styles you're comfortable with, and being willing to kind of experiment a little bit and kind of change up your approach and evolve, mature, and just like learn your lessons. Take a little bit of Badger and a bit of Monkey and maybe a bit of like a whole bunch of other podcasts and investors, famous investors that you like, and then adapt it to your own style that fits your circumstances.
That's exactly what I was trying to say. Adapt, ability to adapt and being flexible. And it's so obvious. It does feel like one of these truisms that like is cliche. Well, of course, but human nature being what it is, very few people are actually capable of doing this, because it has to do with their own identity. And then they say to themselves, this is the kind of person I am, and this is what I do. So the thought of changing something is uncomfortable. You kind of really have to work at it, right? And in this moment, to maybe tie it all together, in this moment of extreme volatility, a particular style is definitely more suited to it than another. What that style is requires, stepping back, looking at historical cycles, and looking yourself in the mirror and asking yourself, am I being too tight here? Am I being too fearful? Oh, okay, that means I could probably loosen up a little bit to take advantage of a quote unquote table,
Right.
aka the world market, that is taking themselves, they're too risk averse now. So I'm going to be the one that takes advantage of it by bluffing more. Bluffing doesn't have an obvious analogy in the market, but right, being a little more aggressive with the bets you're making, to put it that way.
Right. Yeah.
So, over on our Patreon, we've talked about, we have our new fancy Team Badger, Team Monkey mugs. Let's see that handsome. Oh my goodness, look at that! Who wouldn't want that handsome devil to go with their morning coffee? So, yeah, that's for the Jungle Cat tier.
That is our Jungle Cat tier. We have a couple of Jungle Cats. We've got a unicorn. They'll all be receiving their mugs as time wears on at those tiers. There's also like a t-shirt and some stickers. I haven't been sent samples of those yet, but if they look anything like the mugs, they're going to be awesome. Yeah.
Cool.
You get a bunch of other benefits though by being a Patreon, like not the least of which, we've just got like private chat groups where we like shoot the shit, but also one where we talk about our trades, like our actual investment decisions in real time. Ideally, I try and flag there before I've done something. It's rare that I ever do anything, but sometimes it might be, today I did X and this is Y, and we can debate that with our dolphins and above.
Yep. And it's just a way to add a little more time and a little bit more reflection between doing something impulsive. Potentially is when you can go on the channel and say, I'm thinking about doing X, and then you have other eyes on it. And at the very least, you might wait to get people's responses to this idea. And I think it's just a good way of being a successful investor, doing it with community. So,
and we don't want to reveal too much, but we've both got a bunch of really interesting ideas for how we're going to make the Wall Street Wildlife Patreon even more engaging, exciting, and value add for our Patreons. So watch this space.
Yep. Patreon.com/Wall Street Wildlife. We hope to see you there. It's a jungle full of all kinds of critters.
And we got like a small select, looks like about 100 Patreons, and we appreciate them all dearly. We got a couple of thousand listeners to the podcast and the YouTube now, and like if you're not a Patreon, that's all cool. But if you're just enjoying the show, you'd really help us scale, because we want to get in front of more ears, particularly while the market is so wild and crazy right now. Tell a friend, just like send a link to our YouTube or send a link to the podcast to someone who you think might get a bit of value out of it, and let's spread the word a little bit.
Amen and hallelujah.
We should give a quick shout out, as we always do, to our partner FinChat, finchat.io/wildlife, to get a handsome discount. We use FinChat today to look at the S&P drawdown, but I use it literally every day. I used it to figure out my price targets and look at my price to free cash flow historical ratios. I use the screener increasingly to try and identify interesting new opportunities. It's our favorite investment analytics tool.
Very much so.
Are you ready to become a beast of an investor?
Your journey starts right here.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.